Imagine you're the main provider for your family. You work hard, save money, and invest for the future. But what happens if something unexpected happens to you? How will your family manage financially? In this video, you'll learn what life insurance is and why it matters, how it works as a risk transfer tool, a fascinating history of insurance, and different types of life insurance available in Canada. How real families use life insurance to protect their loved ones, and how to determine how much life insurance you need. By the end of this video, you'll have a clear understanding of how life insurance works and how it can fit in your financial plan. Part 1. All right, let's start with the basics. Life insurance is a financial contract between you and an insurance company. You agree to pay regular premiums, and in return, the insurance company promises to pay a lump sum, called a death benefit, to your beneficiaries if you pass away. Why is this important? Because it provides financial security for your loved ones. Life is unpredictable, and while we hope for the best, we should always plan for the unexpected. Example, let's say you have a spouse and 2 kids. If you suddenly pass away, your income stops, but the mortgage, utility bills, and grocery costs don't. A life insurance policy ensures that your family has the financial support they need. Part 2. Now let's talk about risk transfer, because it's the foundation of how insurance works. Every day we face financial risks, some minor, like spilling a coffee on your laptop, and some major, like serious illness or accident. Risk transfer is a financial strategy where you shift large potential financial losses to an insurance company in exchange for smaller predictable costs, i.e. your premiums. Analogy time. Think of a group of 100 people, each putting $10 into a pool. If one person experiences a major financial loss, the pool of money covers them. That's how insurance works. Many people contribute so that the financial burden is shared. Example, just like car insurance helps cover accidents costs, life insurance helps your family financially when you're no longer there. Part 3. You might be surprised to learn that insurance has been around for thousands of years. Ancient Roman Greece, over 2,000 years ago, Roman soldiers created burial clubs to cover funeral expenses if one of them passed away. In the 1600s, merchants and ship owners gathered in coffee houses in London to insure ships. If a ship sank, the group covered the loss. 1700s is the birth of life insurance. The first modern life insurance policies were created in the 18th century. 1800s, life insurance comes to Canada. Insurance expanded across Canada, helping families and businesses manage financial risks. Today, life insurance is a key part of our financial planning, with millions of Canadians using it to protect their families. Part 4. Now that we understand the basics, let's look at the 3 main types of life insurance. Term insurance. It's simple and affordable. It covers you for a set period, example 10, 20, maybe 30 years. If you pass away during that term, your family gets the payout. There's no cash value. Once the term ends, coverage expires. Great for mortgage protection, income replacement, or business coverage. Whole life insurance, which is lifetime coverage and cash value. Whole life is permanent coverage, meaning it never really expires as long as the premiums are paid. It also builds a cash value over time, and there are 2 main types of whole life insurance. Participating or par whole life insurance provides dividends from the profits associated with the pool of whole life policy owners. Dividends can be used to buy additional coverage, reduce premiums, or be taken as cash. Depending on which option you pick, these policies can offer long-term growth potential. There is the ability to have the life insurance premiums paid by the policy once sufficient cash value has been created. Typically, this can take up to 8 to 12 years. Non-participating whole life insurance. No policy dividends, but guaranteed cash value growth over time. Premiums remain fixed for life. Fixed death benefit offers predictable lifetime coverage with no market fluctuations and lower costs than participating whole life insurance policies. Universal life insurance. Universal life insurance offers greater flexibility than traditional term or whole life policies. It allows policyholders to adjust premiums, investments, and death benefits, but also requires more active management. And here's what you need to know. Flexible premiums. Unlike other life insurance types where premiums are fixed, Universal life policies allow adjustable payments. Policyholders must pay at least a minimum premium, which covers mortality costs and policy expenses. Excess funds can be invested within the policy, creating a tax-advantaged savings component. However, using yearly renewable term pricing where the costs rise over time can be risky if the future payments become unaffordable. Flexible investments. Universal life allows policyholders to allocate funds across different investment options like mutual funds, GICs, or index accounts. Investments grow tax deferred, making this policy attractive for high net worth individuals who have maxed out their RSPs and TFSAs. Flexible coverage and death benefits. Policyholders can choose between level death benefit, which is a fixed payout and the lowest cost, or level plus account value, which is the death benefit plus growth from the investments, which is the highest cost. Level plus cumulative premiums, or in this case, death benefit increases as premiums are paid, or an index death benefit just that adjusts with inflation. Consumer accountability. The policyholder is responsible for investment decisions, premium adjustments, and long-term sustainability. Poor financial management could lead to a policy lapse or underfunding. Transparency and control. Unlike whole life insurance, universal life insurance policies provide detailed annual statements showing investment growth, fees, and available account values. Universal life insurance offers flexibility but demands active oversight. It's best suited for individuals with higher financial literacy who are comfortable managing investments and premium structures over time. So which one should you choose? In trying to determine what policy is the right policy for you, it is important to remember the following. What is the underlying purpose for this insurance? At the heart of insurance is the concept we touched on earlier, which is the transfer of risk. The important thing to remember when looking at permanent insurance, regardless if it's whole life coverage or universal life coverage, is if these premiums are going to sacrifice current or future lifestyle goals or financial security, then they're likely not the right product, or at least not at the right product at the right time. Part 5. Before diving into the numbers, let's focus on what really matters. Life insurance is about protecting your loved ones from financial hardship. It's not about buying the biggest policy possible or just picking what you can afford today. It's about making sure your family has enough to stay secure if something happens to you. Here's what to consider when determining how much life insurance you may need. What debts do you have? Mortgage, student loans, credit cards, car loans, line of credits. How much income does your family rely on? Would you need income replacement for 5 years, 10 years, or 20 years? Do you have kids who will need money for education? What final expense do you expect to have? Funeral, legal fees, estate costs. When thinking about income replacement, think about the following. What would be the burden to your surviving spouse of raising however many kids you may have, clearing debt, funding some of or all of your kids' education, and still saving for retirement? Now, each family situation will be different and might require more or less coverage. It's also important to consider existing savings, investments, or other financial resources that could offset your coverage needs. When you can't afford full coverage or it might be too expensive for your budget, here's a smart alternative. For many young families, a Term 20 policy that fully meets your needs may actually be financially out of reach, and that's okay. Without having to compromise on coverage, consider starting with a Term 10 policy that can later be converted into a Term 20 as your financial situation improves. Why is this smart? It's more affordable upfront, making it easier to get the right amount of coverage now. It protects your insurability, meaning you can extend coverage later without medical exams. It offers flexibility. As your income grows, you can upgrade to a Term 20 policy when you can afford the higher premiums. This strategy is especially beneficial for families in the early stages of their careers. It allows you to secure the right coverage today while keeping the door open to extend it when your income increases. Part 6. Permanent life insurance can be a powerful financial tool, but it's not for everyone, and it's important to understand when it makes sense to include it in your plan. My recommendation is to prioritize your financial goals first. Before committing to whole life or universal life insurance, it is crucial to understand you've already taken care of your own financial needs and priorities. For example, making sure that you have an emergency fund to cover 3 to 6 months' expenses, paying off high interest debt, credit cards, or personal loans, maximizing retirement savings, contributing to RSPs, TFSAs, and other investments, having some surplus wealth trapped in your corporation, wealth that you are not expecting to need to fund your retirement. Your retirement lifestyle should be fully funded with surplus. You shouldn't have to compromise your lifestyle today or in retirement to pay for this insurance. Part 7. When you secure a mortgage, your lender may offer you optional mortgage protection insurance, an insurance product designed to cover your mortgage payment or pay off your remaining balance in cases of death, critical illness, disability, or job loss. Now, at first glance, lender-offered mortgage insurance may seem convenient and affordable. While often it appears to be cheaper initially, there is some key factors that many overlook. Your premiums typically remain flat, but the coverage amount, the actual payout that your family would receive, declines over time as you pay down your mortgage. So you're potentially paying more for a significantly less coverage. In contrast, personal life or critical illness insurance provides fixed coverage, offering greater long-term value and peace of mind. Part 8. When buying life insurance, understanding how the policy is underwritten is critical. There are two main ways. There's post-claims underwriting, which is commonly used in mortgage insurance from lenders. It means that you don't undergo much health screening when you apply. Instead, the insurers review your health history only when a claim is made. If any medical conditions or omissions is found at that point, your claim could be denied, even if you've been paying premiums for years. With upfront underwriting, on the other hand, this means that the insurer evaluates your health and lifestyle before issuing the policy. If you are approved, you can have greater confidence that the future claims that might be made in the future will be paid. Policies with upfront underwriting offer more certainty and reliability. When it comes to protecting your family, peace of mind matters. Part 9. Let's do a quick recap. Life insurance protects your loved ones. It transfers financial risk to an insurance company. Insurance has been around for centuries. There are different options: term, whole life, and universal life. Understanding your insurance needs ensures you get the right coverage. If you found this helpful, hit the like button and subscribe for more financial tips. Thank you for watching. I'll see you in the next video.